Hey everyone, it's Tom Kratz. I'm down here in the corner, and this is a question that we're getting a lot. Is widespread inflation lurking in the shadows here in Canada? Is it coming? Does it spread beyond real estate? Because we've definitely been getting it in real estate. We've been getting it in real estate in some capacity for the last 10 years, but especially in the last year. And if you've been following it, it's been going crazy in the last few months. But the broader question is inflation going to rip right through the broader economy? And I think that's a question we're hearing a lot. It's a question we're asking ourselves. So we just pulled some data together to have some kind of fun with this question, although it is a very serious matter, and see if we can kind of make sense of what's going on. The things that we really pay attention to are that you need the raw material to create inflation. So you need the money in the system. And it's a psychological thing as well. If there's money in the system, but we all just hide under our mattresses, keep it in the bank, don't go into the economy and spend it, you're not really going to get broad inflation, in our opinion. You're always get inflation when interest rates are low at the point of real estate, because that's where new money is created. When you and I create a new mortgage, money is created out of thin air and money enters the economy. It's why real estate gets the inflation first. It's why it's good, in our opinion, to sidestep inflation by holding hard assets. They benefit from inflation before anything else will go up in price. Hard assets will kind of maintain their value and go up in price, and we can talk about that at another day. But for now, there's a couple components. Is a raw material, is there enough money in the system, and will a psychology change in the economy where people are spending it broadly, and will that bring on the inflation? So if we look at this, there's something interesting going on here in Canada. M1 is our base, our monetary base. M2 is more the broad money, more the broader count of money in circulation. And you can see the broad money count of M2, this green line here, is going up. So there is enough raw material out there for all of us to spend. In fact, there's some data floating around that says checking accounts by Canadians have about $90 billion more money in them than last year at this time. 90 billion is a lot. I think that's 4 or 5% of our entire GDP. So there is a lot of money sitting in checking accounts ready to come out into the economy. It'll just be more a question of if that happens or if it doesn't. And if it does, we think we have the raw material there to create broad inflation right through the economy. And we want to flip to the US here temporarily in this discussion, because Canada always copies the US. You know, whatever the US does with interest rates, we're going to copy. If they don't raise them, we don't raise them. We even keep them below because we want our dollar to be weaker for our exports and that whole thing. So it's interesting just to follow the US to see what they're doing, because if they're going to add more debt, we're going to add more debt. We are even doing a better job than them at adding debt, which is a very serious matter. So I'm not trying to make light of it, but we do add a lot of debt in this country, and I'll share some more of that in a second here. But if you look from 2009 or so, debt in the US has tripled. So it's currently about $27 trillion. It's tripled, right? From about 9 trillion or so to $27 trillion. So over the last 10 years, it's tripled, and that's very instructive for us to kind of follow, because it allows us to extrapolate some of these things out and kind of anticipate what might be coming in our future. So if it triples again from 27 trillion over the next 10 years, 27 times 3 is going to be $81 trillion. If there's a 1% rate hike on an $81 trillion amount of debt, that's $810 billion in interest payments a year, which is an absolutely unimaginable amount of money to go towards interest, but $810 billion a year in interest on the debt. So now let's look at how much revenue through tax receipts that the government in the US brings in. Well, they tripled their debt in their last 10 years. And if you look at the last 10 years of tax receipts have only gone up about 50%. So tax receipts have gone up about 50%. So they tripled their debt, but they were only able to increase tax receipts by 50%. So now we already can tell there's a structural broken problem in the economy, that they're growing the debt much faster than they're pulling in revenue. This can't go on forever. You just need more and more debt to bring in less and less revenue. So to us, this is a sign that more debt's going to enter the system. More debt means more money floating around the system. And it means that the likelihood of inflation seems to increase, in our opinion, over the next 10 years, not decrease. So if we look at this, we can have some fun with this, because we can say, okay, if debt goes up to 81 trillion, if we triple it again over the next 10 years, tax revenues only go up 50% if we mimic the last 10 years. So a 50% increase in today's tax revenues in the US would take it from 3.7 trillion or so to 5.5. So they go to about 5.5 trillion. Here's where things get interesting. If we go to the Congressional Budgets Office website in the US, they're spending $345 billion or so on interest payments right now. $345 billion is 11% of their current tax revenues. So 11% of tax revenues are going to interest. Here's where things get crazy. If a 1% rate hike on the debt at the end of the next 10 years is 81 trillion, that's $810 billion. A 3% interest rate hike would be $2.4 trillion in interest payments. So if today 11% of tax revenues is going towards servicing the interest, if tax revenues go up to 5.5 trillion, because we're just kind of like rolling forward the last 10-year trend, and interest rates were to go up 3% to $2.4 trillion in interest payments, that would be 44% of revenues. 44% of all revenues would just be going to service the debt. If rates ever went to 6%, 88% of tax revenues would go to service the debt. So, and this is, I guess, our long way of saying interest rates are never going to go up. Mathematically, they just can't go up unless something changes. If interest rates are never going to go up in any meaningful way, I don't mean a quarter point or a half point. I mean like 3%, 4%, 5%, 6%. If they're never going to go up, they're going to stay low. I guess more money floods into the system. I guess asset prices just continue to inflate up. And I guess we're going to see inflation trickle beyond that as well. I mean, we don't have a crystal ball, but this doesn't look good. You're increasing debt at a rate much faster than you're increasing revenues. And it's preventing you from raising interest rates. So if inflation ever does start ripping through the economy, how are you ever going to raise interest rates to stop it? And in Canada, remember, we just copy what the US does. So we're going to have the same situation here. And in Canada, here's Ontario. This gentleman, Joseph Barbudo, put this up on Twitter, and it caught our attention, this Ontario public debt chart here. And if I kind of zoom in on it here, you can see from 2010, we were 194 billion in Ontario in debt. We're now 353. That's about $160 billion increase in the last 10 years in this province. So how are, if inflation goes up and we just keep printing this much money and this much debt to service just the, what the government needs, how are we going to ever raise interest rates to stop the inflation? But it definitely looks like we're going to be throwing a lot more debt. Like, look at the trend line of this. How does this go down? The economy would have to grow faster than the debt, but we haven't seen that in the last 10 years. What's going to change? And maybe it changes. Like, I want it to change. But I just kind of scratching my head. In Canada, we're not alone. The whole world is just increasing in debt. The total global debt now is 281 trillion, or 355% of global GDP. Canada, we're holding our own. You can look at this green bar in here. Look at how much government debt we're adding in here. Look at the size of this green bar. This is the general government debt on this chart here. If you compare this green bar to other countries here, I mean, the government of Canada is just loading in debt. There's another chart somewhere that I saw recently per capita. I think we're like number 1 or something in the amount of debt we've added in the last year. But anyway, this is instructive. This is all the debt we've added in households, non-financial corps, and general government. And if you go to the Government of Canada's website, budget.gc.ca, and you pull up the fall economic statement, you have to go all the way to page 142. But you find this on page 142 that our federal debt is expected to be 1.4 trillion, or 55% of GDP. Remember, that's just federal, by 2024. 1.4 trillion in this country. Like 1.4 trillion. So we're approaching the size of our GDP here. And there's this awesome article on the CBC. The $1 trillion question is how federal spending will position the economy for post-pandemic success. And this article has this paragraph here. It says, if you factor in the extra spending that they anticipate is coming, our debt could climb to 1.7 trillion. Never mind the 1.4 that's reported in the government document, 1.7 trillion. And they have this statement in here that the federal government will have effectively added 1,000 billion, which is $1 trillion, to Canada's debt since 2019. So if our total debt is 1.4, or going to be 1.4 shortly, or 1.7, think about that. We've added a trillion of that total 1.4 in the last 2 years. We've added $1 trillion of the 1.4 in the last 2 years. What is coming? And we think if more money floods into the system, it's going to leak out to the broader economy and create inflation. I mean, maybe we're wrong. Maybe it just stays with assets and the stock market and that kind of stuff. But it seems like the raw material is there to get broad inflation. And here's the bigger question, which is a sad question to even think about. But with more government cash spent on interest payments and less cash available for actual services for citizens, doesn't the standard of living decline for anyone who's not protected from this? I mean, if the government just is spending more of their tax revenues in Canada, in the US, everywhere, and let's say in developed countries, on interest, don't they have less money to pay for social services that kind of like we all need to have a nice, healthy society? I mean, there's interesting stuff headed our way. How can this system keep working? How do you increase government revenues faster than the real economy is growing? Because the government revenues have to increase faster just to service the debt, or we just never get out of this debt spiral. How does this work? When you need more debt, when more debt increases the economy slower and slower, how do you kind of get out of this spiral? Like, we're clearly in this death spiral, in our opinion. Did I say debt spiral or death spiral? It feels like a death spiral. So what do we all expect? Wealth taxes, capital gain changes, all sorts of new taxes. I mean, this is coming. The government's going to need more revenues. If they can't get it just from the broad economy, they're going to have to tax us. So we can all expect this. I mean, everyone can adjust what they feel they need to adjust, but this is coming. I mean, the capital gains changes I anticipate, or we think in this next budget that's coming our way, they're going to make that first announcement that unless there's an election that kind of postpones some of that budget stuff in Canada. But you got to think capital gains changes are coming as a first step in this kind of thing. And all sorts of new taxes are coming. Anyway, I'm getting off the inflation topic here. But in general, inflation, does it spread beyond real estate and get broad? And it looks like the raw material is there. When does the confidence in the dollar and the bond market break? So like if all these dollars start flooding the system, does it leak out to the broad economy? It looks like, remember, there's two things to inflation. You need the money in the system, but you need the psychological impact of people who want to go and spend that money. If you just save it, you don't get the inflation. You don't get the turnover, you don't get the velocity. So if we all just kind of save it, we don't get the inflation. So what can we expect in that kind of situation? When does the confidence in the dollar break? When does the bond market break? People that are holding bonds for 10 years, 30 years, when do they just not roll over that debt? And what kind of contagion does that bring into the market? Because that contagion would be awful. That would be a credit event, and that would be awful. So we have a lot of the ingredients for inflation. There's a lot of raw material. There's a lot of raw material in the system, and it looks like as we come out of this pandemic and people start spending money, we have the opportunity for broad inflation to be here. So to us, the time is to protect you and your families now. To us, that means hard assets, whatever that want. Everyone can decide how to protect themselves. Some people like gold and silver. We're big fans of. We've been gold and silver fans for 10 years. In the last year, we've been really kind of deep down the rabbit hole of Bitcoin. So you want hard money, gold and silver, if that's your thing. Bitcoin, that's lately been our thing. We're kind of big fans of it. Real estate, income producing hard assets. And the reason we say income producing hard assets is that if there ever is a market event where there's a banking situation, a credit crunch, assets really come down in price because no one's lending. And the whole market's built off credit. So it's the income component that we refer to as the unicorn. You want income streams in those kind of situations. And today everyone kind of discounts income streams. But income streams in that type of environment are very beneficial. Anyway, I'm getting off topic. We can talk about that another day. But definitely it seems like the ingredients are in the system for broad inflation. We'll see if it happens. I guess by this fall we'll know. We'll see if it hit or if it didn't hit, if it just stayed in the real estate market, and if it, it's kind of isolated to assets, or does it go broadly through the economy? We'll know soon enough. Hopefully you find that useful. Until next time, your life, your terms.